Hey guys, we are back with video 26 of the series. Today we are looking at a Dividend Achievers ETF, or RDVY. It is First Trust's Rising Dividend Achievers ETF. We're going to see how much of this ETF we need to own to hit $1,000 a month. First off, we're going to go over to their webpage and try to determine what they are doing to give us a dividend or pay us some income. We're going to head over to Seeking Alpha and check out their holdings page as well as their daily dividend yield chart to come to a conclusion of what dividend yield we want to use on average that we would put in our calculator to hit that $1,000 a month. What calculator are we going to be using? We'll be using our compound interest analysis calculator, where we can predict portfolio values and income values on a rough basis, changing around growth and contribution, as well as dividend yield and expense ratios. But more on that later. And then we'll round out the video and compare RDVY with the S&P 500. Over on First Trust's website for RDVY. What is RDVY? Well, the fund seeks investment results that correspond generally to the price and yield of the NASDAQ US Rising Dividend Achievers Index. The fund will normally invest at least 90% of its net assets in securities that comprise the index. The index is composed of the securities of 50 companies with a history of raising their dividends and exhibit the characteristics to continue to do so in the future. And then they go into some detail of the criteria of the securities that they have in this ETF. I like First Trust. They are very open about what they're actually doing in the ETF, which is pretty cool. Just to highlight this second bullet point here. So to be eligible for inclusion in the index, the companies must have, and then they have 4 main points right here. I think it's pretty cool to actually read and try to determine why that these securities are in the ETF in the first place. So we'll take a look at what these securities are over on Seeking Alpha, but in a nutshell, they pay a dividend in the 12-month trailing period greater than the dividend paid in the 12-month trailing period 3 and 5 years prior. They have positive earnings per share, or EPS, in the most recent fiscal year greater than the earnings, or EPS, 3 fiscal years prior. And they have a cash to debt ratio greater than 50% and a 12-month trailing period payout ratio no greater than 65%. So those are the 4 criterias for the securities to be able to be in this ETF. Just a quick note. The inception date of this fund was in 2014, so it does have some history, about an 8 coming up on a 9-year history here very soon. And just real quick, as of September 23rd, 2022, these are the top 10 holdings, and we'll compare these to what Seeking Alpha has as well. So Apple, Johnson & Johnson, and Pull Tate Group, Allstate, United Health, Humana, Texas Instrument, Aflac, Microsoft, and Qualcomm. Do recall that these are companies in the NASDAQ index. Coming over to Seeking Alpha's webpage, and you can see that their sector breakdown, they are actually only in 9 different sectors. They do have the largest amount of their holdings in the financials and technology sector, being around 61% of the total ETF. And these are the top holdings according to Seeking Alpha. So there might be some discrepancy. You can see August of 31st. So this is about a month old compared to what First Trust's website is telling us. So this is going to be more accurate or up to date. Apple, Johnson & Johnson, Pulte Group being the top 3. Coming back over to Seeking Alpha, coming over to the daily dividend yield chart, we can see that the dividend yield for this ETF is actually fairly low in comparison to some of the other dividend ETFs that we've analyzed here in this series. It's dropped down here in the past 5 years all the way down to about a 1%. And then it's been all the way up to about a 2% here recently. It looks like it has been increasing. The dividend yield has been increasing, probably twofold. They have either paid a higher dividend payout and or the price of the ETF is actually dropping, which is increasing the dividend yield. So let's take a look at their payout and their price history to see if it's a combination of both or if it's just one or the other. Taking a look at their payout history, you can see that there is a slight trend in the upward direction here from starting in January or March of 2017 all the way until September of 2022. It looks like it has been on a steady incline, even though it is a little erratic, but overall it looks like it is increasing over the past 5 years. So that dividend yield does look like it is increasing. Let's take a look at the market price as well as the dividend payout, paying a little bit more than it has in the past 5 years, and their 5-year market price. It looks like it has started to increase, but in the past year here in 2022, it has had a small decline. So some of the dividend yield numbers may also be inflated due to the decline in the market price. So let's head back over to our compound interest analysis calculator, and let's use that figure of 1.9, which was the 12-month trailing yield. Let's type in RDVY. RDVY, First Trust's Rising Dividend Achievers ETF. We'll forget about the rest of the spreadsheet and just simply look here. So for RDVY, you would need $631,000 of RDVY to hit $1,000 a month. Now let's compare RDVY with the S&P 500. If we were to take $500,000, taking a look at reinvesting dividends, and then we'll see what it looks like without reinvesting dividends, comparing that to SPY or the S&P 500, an ETF that mirrors the S&P 500, analyzing the portfolio, and here we are. We can see that RDVY almost tracks the S&P 500 over the course of the last 9 years. Very close here. RDVY having a cumulative annual growth rate in the past 9 years of 11.72, and SPY having a cumulative annual growth rate of around 11.76. So SPY slightly outperforms, but just on a marginal basis. If you started with $500,000 9 years ago, with no new monthly additions, your final balance with RDVY would be $1,294,000, and with SPY, it would be $1,298,000. Coming down to what the portfolio incomes would be, you can see that they would have paid out a very similar dividend payout. And let's see what it would look like if we did not reinvest the dividends. If you were to pay yourself with that $500,000 in that asset of $500,000, paying yourself that dividend and not reinvesting it into the funds, starting from January of 14, the inception date of the newest fund, which is RDVY, it looks like in this time period, RDVY would marginally outperform the S&P 500. For RDVY, a cumulative annual growth rate without dividends reinvested of 9.81 and 9.72% CAGR for SPY. And then the dividends you could have expected to receive over the course of the last 9 years. It looks like the largest dividend income that you would have received would have been in 2020, around $16,000 paid over the course of the year. So that is it for RDVY. Let me know what you thought of this video. Hit that like button. Really helps out the channel. Subscribe if you want to see the remainder of these videos when they come out. And with that, thanks for watching.